Good morning and welcome to the Balancing Act. I'm Montel Williams. Today, a special edition as we learn more about a better, faster, and easier way to pay off your mortgage. And it all starts right now. You know, home ownership has long been the American dream, and the home buying process has, for the most part, remained the same. Apply for a mortgage and then pay it off over the next 30 years. Well, unfortunately, this archaic process puts homeowners at the mercy of the banks for far too long, causing stress, excessive interest charges, and financial strain for seemingly no reason whatsoever. Well, today, we have Mr. Shane O'Grady, who's the founder of Life Changer Loan, to show us that there is a better, more streamlined way to pay down your principal while simultaneously building up your equity. Welcome and thank you so much for being a part of the show today.
Montel.
Absolutely. Look, less stress, less interest, more flexibility. Come on now. Sounds good to me.
Yeah, absolutely. I love that you use the word archaic because we are, the gold standard now in mortgage lending is this 30-year fixed, which truly is archaic, right? It came around during the Great Depression when most Americans were financially destitute and banks had to find a way to make housing affordable, right?
And to make extra money.
That's right, that's right.
Sure.
So they stretch these payments out over 30 years and then they throw in amortization so they get all interest paid to them first. And here we find ourselves 100 years later still using this archaic process.
Sure.
And as of today, Americans are about $13 trillion in mortgage debt, of which they're only about 2 or 3 years into a 30-year fixed on average. And so we find ourselves at kind of this impasse where something needs to change because this process isn't working for American homeowners.
Gotcha. Well, I mean, most people who want to get a mortgage, they go to a bank, they apply, they see if they qualify, and then they sit back to see if, I'm going to get what I want. But you have something different in mind.
Yeah, so Life Changer Loan, we kind of look at this a different way where you have two buckets. You have your bucket with your income and you have your bucket with your debt. And that income bucket kind of stays over here in banks and that money just sits around waiting to be spent. And then it goes towards these debts, right? And hopefully we have more in this income bucket than we do in this debt bucket at the end of the month.
Sure.
Life Changer Loan combines both of those. So now we can have all of our income working towards all of our debt to allow us to pay off substantially quick while keeping access to our money.
Wow, so Life Changer Loan is a special type of loan where, explain the difference between, let's say, an interest rate and interest cost. How does that affect your mortgage?
So whenever we start talking about mortgages, the very first question to always pop up, Montel, is, well, what's the rate? When really the question should be, how much am I going to pay in interest?
Sure.
Right? Because really you want to know how much above the cost of the home am I really going to pay towards interest? So although we think that's related to interest rate, it's really more related to interest cost.
Gotcha.
So if we can compress that time, so instead of 30 years, the average Life Changer Loan client pays off in actually 5.
What?
5 years, Montel.
Okay.
Without changing a dime of their spending habit. And
costing them less.
Costing them way less. Even though interest rates may be higher, their overall interest cost is substantially less because it's so much less time.
And how is this more efficient way to, let's say, to finance a home?
Well, so instead of a mortgage, what we do is we do a line of credit in first lien position, typically up to 80% of the value of the home. So if they're purchasing, they're putting 20% down. If they're refinancing, we do that line up to 80 just so they can have access to their equity. And then, but what's so different about these lines of credit, Montel, is they're tied to a fully functional checking account that is known as a sweep account. And it just means that all the activity from that checking account is sweeping to the balance of the line every night at midnight. So they're effectively doing their banking inside of their mortgage. So now they're paying 100% principal first with 100% of their income without any fear because they have access to all the money to pay their bills. And as long as they're putting more in than taking out, it creates this huge snowball which allows them to pay off very quickly.
Wow, well, it's not magic. This is just math.
Just
right?
math.
Which is really interesting. So tell me some of the most, pervasive questions that you get from people about this kind of loan.
The too good to be true. Why isn't everybody doing this? In the United States, if you think about all the large mortgage servicing companies, they happen to also be large depository banks like Wells Fargo, JP Morgan Chase, Bank of America. They'll never be on board with this loan because if they lose you as a depositor, that's not a good thing for the bank. Right? Plus, from the mortgage side, not many mortgage companies like to offer this loan because nobody refinances. There's no need to. And even if they buy other property, they don't need another mortgage, right? They can just pay cash. So it's a one-shot deal, and there's not a lot of people on the mortgage or banking side that really want you to know about that this exists.
Well, Shane, you gave us some real-life examples, so let's take a look, okay? Take a look at this.
So as we jump into a few examples here, I think it's of note that this is not a new concept. This concept has been around for decades in other countries. In fact, in Australia, this loan represents almost 40% of all the mortgages done. It's very popular in New Zealand. Canada has a version. The UK has a version. They're called offset loans because you're offsetting the principal with your income. So as we jump into our first scenario here, this is a young gal out of Colorado, and she is a first-time home buyer. She's buying a $300,000 property, and she's putting 20% down. She's been a Dave Ramsey disciple for quite some time. So she's got this, we're going to compare to a traditional loan amount here of $240,000. At the current interest rates, we're about 7.5% currently. With her income, she makes a good income. She deposits about $7,500 a month into her regular checking account. And the question that's posed to her is, if you have this traditional mortgage payment of, call it $1,678 a month, how much of that $7,500 would be left over after you paid all your bills? Because the idea here is that you don't change anything other than where you're depositing and spending from, and then just letting the math take care of itself. And she admitted that she's probably going to have quite a bit of new expenses in this new home, right, with regard to furnishing and whatnot. So she wanted to be very conservative, and she came to the conclusion of about $1,500 a month is about how much she'd have left over after she paid that traditional mortgage payment and all of her other existing bills and kind of new bills with moving into this new home. In that scenario, you'll see that on a life changer loan, she would pay that mortgage off in 9.3 years and save about $248,000 in interest compared to a traditional loan. Now, to make sure that we're all on the same page here in terms of how this is happening mathematically, the principal is just declining every month by that deposit. So it's going down $7,500 a month. When she makes those deposits, it's going back up by her spending. So in this case, it's going down $7,500 and going back up $6,000, down $7,500, back up $6,000, and just wash, rinse, repeat. Now, the beauty to the loan is that when she deposits $7,500, yes, that's considered the payment because it's lowering principal balance. But the beauty is it doesn't feel like a payment at all because she's just doing her banking. She has access to all the money. And then what she feels in terms of a monthly mortgage expense is really just interest based off the balance. And that number will continue to get cheaper each and every month as that balance declines. Also, we like to point out when we're comparing to a traditional loan over 30 years, since she's going to be able to pay off here in a little over 9 years, we like to see, well, how does that compare to a traditional loan? So when she gets to a zero balance, you'll notice here, she would actually, in that same time frame, still owe over $207,000 on a traditional loan. So amortization is the silent killer. Obviously, more positive cash flow is allowing her to pay off faster. Less positive cash flow would allow it to pay off a little bit slower. In our next scenario, this is a couple that just recently sold a property, and they're buying a new property, kind of a step up with their young family. So they're buying at $650,000, putting 20% down. And again, we're comparing to a current 30-year fixed at 7.5%. Between the husband and wife, they deposit about $12,500 a month. They don't really have much left over in their checking or savings after they're putting down that large down payment. But the question to them was posed, okay, after you deposit $12,500 and pay this traditional mortgage payment of $3,635, how much of that $12,500 would typically be left over? They tend to be pretty conservative. They don't have a lot in the way of credit card debt or vehicle debt. And they were comfortable being at a conservative number of about $3,750 left over after they would pay that traditional mortgage payment. In that scenario for this couple, you'll see that they would be paying off this mortgage 8.4 years and saving over $564,000 in interest compared to the 30-year fixed. Now, I think it's important that we point out the downside. What is the real downside? The downside is that the rate's higher. In fact, as of this taping, it's about 9.1%, and it adjusts every month with the 12-month Treasury Index. Our clients don't care because it doesn't really impact their outcome because they're not paying on an amortization schedule. So, for example, in this scenario where they pay off an 8.4, you'll see that we're doing that in a stable interest rate environment where the rate is staying at 9.1 the entire time. Probably not very realistic. If we want to see what would happen if we use the 25-year historical rate, you'll see it's here at 7.1. They actually pay this property off in 7.7 years. But most of our clients want to hear worst case, right? What if the rate just goes absolutely bonkers? Well, you'll notice that there is a 6% lifetime cap, meaning the highest the rate can go is 6% above the start rate. So even though rates haven't been that high in almost 40 years, most of our clients want to see worst case, that the rate just goes as high as it can, as fast as it can, never comes back down. In that scenario here, you'll notice even in the worst case scenario rate-wise, this couple would still pay off this property just barely over 10 years and still save $386,000 in interest compared to that traditional loan. So extremely powerful, obviously, when your deposits are working in your behalf. And for clients that have a struggle kind of conceptualizing this, I think it's always easier to look at on an annual basis. So for this couple, if they're borrowing $520,000, if we just look at it on an annual basis, they have between their two incomes $150,000 a year going to the principal balance of the loan. So now it's really just all around their spending. And most of our clients, currently over 90% of our clients, pay off faster than they originally anticipated, but it's because it becomes like a game to them, and they want to just see how fast they can make it go. Now, in our next example here, this is actually, I think, probably more prominent for our clientele, where we have a husband and wife that are wanting to retire here in, let's say, the next 5 years. But unfortunately, they're only 2 or 3 years into a 30-year fixed rate loan. So this couple, notice they still owe $450,000 on their property, and they love their rate. It's at 2.5%. So they're very cautious about doing anything about that, but they also don't want to go into retirement with a large mortgage payment. So they're roughly 2.5 years into this loan. Between the husband and wife, they deposit about 14 grand a month. In addition, they currently have about $96,000 sitting in low interest bearing accounts like checking and savings and things like that, which they would be able to actually put onto the balance right away to help pay this down, because now they could put it on the balance, drop their principal, drop their interest, but keep access to all the money. And after they pay all their bills currently, they have about half of that left over. They also don't have any car payments, credit card debt. So they have about $7,000 left over currently after they pay all their bills. And remember, they're very cautious about getting rid of their 2.5% interest rate. So this couple depositing $14,000 a month, don't have a lot of credit card debt or vehicle debt. They have about 50% of that $14,000 left over, so they have about $7,000 a month currently left over after they pay all their bills. And for them, you'll see they're actually now paying off this mortgage right at 4 years. They're still gonna save over $100,000 in interest compared to a traditional loan. And they were so worried about getting rid of that 2.5%, and notice they pay off in 4 years here in a stable rate environment, but if we run it at the max, the absolute worst case scenario rate-wise, it will change their outcome by 1 month. And they'll still save over $87,000 in interest. By the way, if their property's worth $800,000, we could do the line of credit to 80% of that number, right? So with that $640,000. So even though they're paying off in 4 years, they will get to keep access to that $640,000 in their retirement to use as they wish, whether they want to buy a second home somewhere or just vehicles or help the grandkids through college. They'll have the flexibility to not only pay down, pay off, borrow back as they wish. So paying off debt and saving interest is the initial reason everybody gets into the Life Changer loan. They become fascinated with the flexibility because of their ability to also not only pay off quickly, but borrow back to buy other real estate. So let's just take our first example here with the first-time home buyer. Yes, this gal can pay off in less than 10 years, but she keeps access to that $240,000. So let's say she borrows back that same amount to buy an investment property. Well, now she's going to increase not only her cash flow, but her positive cash flow. So she's going to increase, let's say she rents it out for $2,000 a month. Well, now not only does she increase cash from $7,500 to $9,500 per month, but now her positive cash flow also increases from $1,500 a month to now actually $3,500 a month. Yes, she paid off the first property, the $240,000 in less than 10 years, but notice on this second property, this investment property, she actually will pay that off in under 5 years. And she'll still keep access to the money. Plus this property is gonna pay her $2,000 a month for the rest of her life. And if she does it again, it'll pay off even quicker. So there's huge wealth building opportunities with the Life Changer loan. It's not just about reducing debt and saving interest. As you can imagine, the number one comment or question is, this sounds too good to be true. And that's why our tagline is, it's not magic, it's just math. So one of the questions that gets asked is, what happens if I lose my job? And my response is always, what happens on your traditional loan? Because I'm pretty sure they don't care. They want to be paid either way. Here, there is no monthly minimum payment necessary. So if you don't put any money in throughout the month, nothing happens other than the interest that's due gets added to the balance the same way it does every month anyway, but you don't go late. We've had people miss as much as 5 years worth of deposits, kind of post 08, because this loan came to the States in 05. And yes, their balance grew while they weren't putting deposits in, but they never went late or risked foreclosure. So not for everyone. I'm 100% convinced for everyone that can qualify. And finally, there's just a few things you need to keep in mind if you want to try and qualify for this loan. You got to have a 700 credit score minimum, 20% equity in the property or a 20% down payment if you're purchasing, 40% debt ratio or less, and finally, you got to have 10% reserves of the max line. So if we're doing a $500,000 line of credit, you got to have 50 grand sitting somewhere, checking, savings, retirement, etc. We just have to prove there's a history of saving money. Obviously, this loan doesn't work for people that don't.
Whoa, that's incredible. That's some really good information, my friend. But look, I have one more question. It does sound a little bit too good to be true.
Yeah, we hear that always.
Okay.
And you know, and obviously it's not for everyone, right? You got to have great credit, you got to have positive cash flow, you got to have reserves, that sort of thing. It wouldn't really work for someone who's currently paycheck to paycheck. But we do strongly believe it's probably for everyone that can qualify.
Wow, really, really, really good information. So if people wanted to get more information, where would they go?
So lifechangerloan.com has tons of information and resources on there. Plus they can get on the savings calculator, run their own scenario, and see if they're a good fit for it.
Well, thank you so much for being here, sir, for
thanks
sure.
for having me.
And you know, of course, remember, lifechangerloan.com, and you can always go and see the segment on our website, thebalancingact.com. Join us on the next Balancing Act. Thanks so much for joining us on this local edition of The Balancing Act. We'll see you next time.